Thanks for joining us today, guys. Today we are joined by Chad Willardson. He will tell us a little bit. His job just ties directly into what our topic is here. So excited to hear some of his perspective, some of his nuggets for you guys as we talk about investments. His whole background is on the investment side, full fiduciary, which he will get into. And so without further ado, Chad, do you want to introduce yourself to the audience?
Sure. Yes. My name is Chad Willardson. I am the founder and president of Pacific Capital. On a side note, I am married 20 years and a father of 5 kids, so keeps me busy. But I've been in the financial services, wealth management industry for my entire career since college. And I started out working for the big Wall Street firm in the wealth management investment side, and eventually left in 2011 to start my own business, become an entrepreneur, serving entrepreneurs as a completely independent fiduciary. In the last couple of years, I've written 2 books. One of them I'll show right here is Stress-Free Money. This came out in 2020. Stress-Free Money is Overcome the 7 Obstacles to Find Financial Freedom. And my other book that comes out next week, September 14th, 2021, is called Smart Not Spoiled. It's the 7 money skills your kids must master before leaving the nest. So I'm excited to bring that out to the world.
Awesome. A lot of good stuff going on, a lot of nuggets, I'm sure, that you've distilled down into your books, and looking to hear a couple of those today. So given your unique experience, would love to kind of unpack the conversation first from a personal perspective for you, right? Obviously building the business, you're an entrepreneur yourself. Would love to kind of hear that aspect, and then we can transition a little bit into, some of those things and how the work aspects kind of started to influence what you were doing on a personal level and where we're at today, right? So big question we like to ask, right? A lot of people on the show are entrepreneurs themselves, looking for, insights. And so once you reach that point where you were building the business where, you didn't have to worry about putting a roof over the head or, taking care of 5 kids and managing that, what was your strategic framework in terms of where you put your money and where you invested and kind of how you divvied up some of that free cash flow?
I think the first great decision I made was to surround myself with amazingly talented people. I had a recommendation from other really successful entrepreneurs to join a specific coaching program. And after I heard it from the 4th or 5th person, I decided, you know what, this is a sign. I better look into this. And so I invested in my own education, let's say, and joined an entrepreneurship peer group called Strategic Coach with Dan Sullivan up in Toronto, Canada. And I believe most of my strategic planning has really accelerated because of my membership in that 10X program. The peer groups, the advice, the counsel, just making me get away to Canada every 3 months to think about my thinking and really think about how I'm allocating my money, my time, my attention, my resources in the business has really made a difference. One thing that they've focused on, though, is really honing in on your unique ability. And for me, that was very eye-opening. And they basically asked us, what if you could only do one activity in your business that would keep you fascinated and motivated for the rest of your life? What would that one activity be? And we really had to narrow it down, like, what are we best at? And then basically hire out or collaborate or outsource or bring in complementary affiliate partners to fill in all the other activities of the business besides my unique ability, so that I could just focus on what I'm naturally good at. And that's been the investment in my own education has been, strategic planning and education has been monumental for our growth. So we hit our 10-year mark on November 11th, 2021. So we started 11-11-11. And my business growth, we've averaged 17.1% a year for 10 years for growth. So we've been very fortunate, despite some of the recessions and COVID and everything else. We've really grown successfully. where have I allocated resources personally? Do you want me to get into that now, or is that?
I'm curious at the beginning, right? So you were talking about, at what point was that investment in yourself, right? Did you acknowledge that, hey, that's more important than the car, or that's more
Right.
important than the, putting money in my own portfolio, right? Like, how did you determine at what point, it made sense to push there versus elsewhere?
I'd say two things. One thing I've always done is, and it's something that I advise clients to do, is I invest weekly. So I actually have an automatic deposit from my checking account. First, it goes from the business checking account to my personal checking account to my personal investment account every week on Monday morning. And it's been that way for years and years and years. The amounts were smaller back in the day, but it's always been a habit of mine to take advantage of compounding interest and just have that forcing function of committing to growth and accumulation. So that's something that we encourage our entrepreneurs to do. I'm not talking about your 401k or your defined benefit plan as a business owner. I'm talking about actual after-tax investments, and getting money put to work for me every week. And I felt like as long as I was pushing money out to be invested into assets that were growing, then I knew that I could focus everything else and all the other resources on my business. So that's always happened. Certainly the amount that I invest and save weekly has gone up significantly since we've grown over the years, but that's always been a commitment of mine. I was never really into toys. It's hard for me to justify it. I know I have some clients that love toys. I mean, I can't say I don't spend any money on a car. I drive a nice Tesla, and I always have loved Tesla for 8 years or 9 years. I've had a Tesla, but I never really was about the flash and the toys. It was more about reinvesting in the business and then trying to diversify out. So I'd say probably 6 years, 7 years in is when I started putting a lot of resources into the strategic coach program and more of the mentoring and coaching and peer groups, masterminds and things like that, which I think have made a massive difference. It's kind of interesting. I've invested in those, and yet the return has been so great that our business has way overgrown the cost of membership and entrance in all those programs. But investing weekly is something that I've done from the beginning. Even when I had to, get really skinny on the business operations side, I was still committed to putting something away every single week.
How did you think about what that number was? Was it a percentage? Was it just hey, I just need to start with $100, and then, right, what was the trigger to kind of increase that? Because I think the default for people is like, okay, I've got something, and now I'm going to go pour everything over here, right? Like, when do you revisit that?
I think it's something to revisit regularly, multiple times per year. I have some clients, some on the younger side, who are high income entrepreneurs, and they love the challenge of making it a little bit uncomfortable and pushing their weekly investment up to where they're not sure how they're going to make it next quarter, but somehow they find a way. It's like you commit to the universe that you're ready to invest at a higher level, and you figure it out. For me, it wasn't necessarily a percentage, but I think that's a great way to look at it and say, I want to save, let's just say it's 10%. I want to save 10% of my gross income and start with that. And at least if it's a percentage, then as your income rises, you're going to continually be increasing what you're investing and saving. For me, I also looked at it as, what would I like to save for the entire year? And let's just break it down by 52 weeks and kind of project forward. If we grow by this much and I'm investing and saving this percentage and this dollar amount, then, I just want to push myself a little bit. So, if you save a little bit each week, at the end of the year, you're going to realize how little you've saved. So you might as well push yourself a little bit and see what happens. Oftentimes we see clients grow into that goal because they've really committed in their mind that they're going to do more than they did last year. So for me, my own business is focused in the investment markets. So we're a fiduciary for clients. Our clients have business ownership, they have stocks, and they have real estate. Those are the three primary categories of investing. And so personally, in 2009, my wife and I started investing in real estate as well, just as another category, another pillar to diversify out of just the private business ownership and the stocks that we've been investing in for years. So obviously since 2009 and 2012, that's gone very well, but we recommend clients diversify their investments. So if you're in a tech business and that's what you own, don't invest all of your outside funds in tech stocks and tech funds. Get outside your industry and spread the risk a little bit for sure.
Is there a general model or a general allocation that you kind of look across that differentiation and or diversification, sorry, and what are those big buckets in your mind that people should be considering?
Yeah, I think most of our clients, what I see is a wide variety of real estate investments, a wide variety of public market-based investments in their accounts, and business ownership, whether it's private placements or their own business. What I think is important is first build up your liquid investment base so you have like a home base. I see a lot of business owners rushing to buy illiquid investments too soon, too premature. Like, let's say someone only has a couple $100,000 to invest and they want to buy a big rental property, but they really have no liquidity. And to me, that's kind of doing it backwards. So we counsel people to really build up that liquid investment base and have money going there weekly, and then look for opportunities that are a little more non-traditional, not liquid. Maybe it's private business opportunities, maybe it's commercial real estate, maybe it's apartment buildings, maybe it's homes, but first build up that liquid investment base that's accessible, that's reachable, and that's growing and compounding, and then start looking outside.
Is that largely because there's not a differentiation between other liquid assets, right? Whether it's, rainy day fund, right? You hear a lot, or, having something in the checking or savings versus that investment, right? It sounds like what I'm hearing is it that the number is too small, or is it that all of the liquid investment are in that space that people are trying to invest that you would counsel to hold off?
I think people they're too enticed by the exciting features of an investment. And I feel like, and don't get me wrong, my wife and I own a lot of real estate, but the exciting notion of being a real estate investor kind of over trumps the prudent strategic investment plan. And so first you should have 3 to 6 months in savings, but no more. Like, especially when interest rates are basically zero right now. We tell people when they're printing money, you should not be sitting there saving money. I call it dusty money. It's just sitting there getting dusty. It's losing value to inflation. You're getting 0.1% at the banks, and you can invest and earn a lot more than that. So 0.1% is not going to get you anything. There's no growth. So yes, have some emergency savings set aside for your business and personally, but outside of that, once you've covered that 3 to 6 month requirement in that bucket, you should be investing, and you should be investing for growth. A lot of times people who are business owners in their 50s or 60s, they think they need to completely dial it back and say, well, I need to take less risk because of my age. But really, if you're going to have a 5 to 10 year time horizon before you spend that money, you need that money growing. You need to beat inflation. Inflation's coming in between 3 and 6% right now, depending on what you're looking at. So you've got to be invested for growth. And I would say beyond 3 to 6 months savings, emergency savings, then all of your money should be invested towards growth. You can have those in a variety of asset classes, but you need to be invested for growth. And we love to see clients have at least 7 sources of income before they hang up the towel. They've got to have a diverse makeup of cash flow before they say, I'm done, I'm no longer working for a paycheck. So that's something that we definitely like to help people build.
I presume in that model, if you've got 2 rental properties, that's considered 2 streams of income towards that 7.
Yes, that could work. Yep. Just spreading the risk. Some clients use creative insurance planning. Some clients have tax-free bonds. That's one of their sources of cash flow. Some clients actually have pensions or defined benefit plans they set up for their companies. And so we just want to see a variety of income sources. The analogy I like to use is having a lot of different fruit trees in the backyard. So if one year the fruit isn't what it should be, you've got other options. And so you've got a variety in the garden. You've got many different sources of cash flow. So you're not dependent on one single source.
That makes sense. When you're talking and the masterminds, the coaching that you came across, how do you counsel your clients when they're looking at their allocations in terms of what they should be putting back in themselves to hopefully grow? For most entrepreneurs, the cash flow is coming from the business that they're creating, right, which is then generating investable dollars to go create other revenue streams. Right. So what's the thinking or the guidance that you provide in terms of hey, you should be investing in yourself, and what portion does that look like? How substantial should that be, right, as they're trying to grow their business?
It might be different at different stages of your business. The number I've often heard is invest up to 10% in yourself and your education. And so I believe it's a serious commitment. I don't think that you should be running the business in a vacuum and only listening to your own ideas. I think it's great to have other successful entrepreneurs and maybe some people who are far above your level giving you advice and counsel, because I think it's important to take advice from people who are where you want to go. And I think I'll make that point as far as kind of a shameless plug here for us at Pacific Capital, is because I'm an entrepreneur and an investor. And so I have multiple businesses and real estate and other things that have grown. If you're an entrepreneur, you should seek fiduciary financial advice from someone who is also an entrepreneur and someone who understands you. So if you're an entrepreneur and that's all you've ever been, and you're going to talk to somebody who is an employee of a big bank, they're not going to understand the trenches. They're not going to have the same experiences that will be able to counsel and guide you through your entrepreneurial journey. It's kind of like asking parenting advice from someone who's never had kids. It's like going to a trainer who doesn't really work out the same way that you do. So I think you need to find a chef that eats their own cooking. And so as an entrepreneur, go to someone who has experienced growth and has done things that you're looking to accomplish or that you're currently accomplishing right now. That makes a big difference. And so investing 10% from the business into your experiences and education, I think, is extremely reasonable.
It's a big commitment, right? And I think one that most people kind of overlook, right? Particularly in the beginning, as they're trying to, particularly if they're bootstrapping as opposed to raising funds in terms of how to make that work, right? Any tips that you would have in terms of, how did you go about finding those people who were successful that you wanted to model your career and life off of?
I really looked for people who were, I'm very active on LinkedIn. I post there daily. A lot of people reach out for mentorship advice on LinkedIn. And it's kind of interesting because I think people want to cut the line a little bit. They don't want to have to put in the time and the patience. And when it comes to business growth, when it comes to investment growth, when it comes to building, let's say, even a social media presence, it takes patience and consistency. So the get rich quick stuff or the get famous quick stuff in my opinion, isn't attractive and it isn't sustainable. So when it came to even just building a LinkedIn presence and finding connections and mentors and peers that were people to take advice from, it took a lot of effort and time. It was a lot of digging. It was a lot of posting and reaching out and connecting. And the same goes for investing and growing the business. It's a game of patience and consistency. It's not something that happens overnight. I think that reaching out to successful entrepreneurs, whether it's friends of friends, whether it's on LinkedIn, whether it's through coaching groups, there's so many people out there that are willing to share. And I'd say the best thing I could advise is ask for advice. no one's offended by being asked for advice. And so if you come at somebody humbly and say, look, I really admire XYZ about you, I'd love to get your advice on something. Don't ask to grab a cup of coffee for an hour and get free advice. Make it simple and specific, and just say, I read your book, or I really admire this about you, and I have this specific question. I'd love to get your advice. So it's concise, it's simple, and maybe you can build a mentorship relationship.
Is a Zoom or a phone call based on, it sounds like you get a lot of outreach. Is that the most logical first step in terms of what you see yourself committing to people who are reaching out?
Oftentimes I'll ask them to put to actually formulate the specific questions they have. And I will answer them, or my executive assistant, I will tell her what the answers are and she'll answer them for me. There are a lot of requests that I think are just flippantly made, often like just like, hey, I want to grab coffee, or I want to do a Zoom call. But if I took up those offers, I'd have 100 of those types of meetings a week, and I would get no work done. And so I don't think that I think you need to be just respectful of the time of those people, and really maybe be very specific on what you want to ask, and just ask for a tiny commitment. Don't make it a big, this person owes me a lot of time and owes me a brain dump of all their experience and knowledge at once. So there's got to be a little bit of give and take, I would say.
What are the elements of that outreach that you kind of identify as genuine, that kind of pull you in, right? So as let's say, I'm looking to, form these relationships, right? Obviously the specific question you talked about tying into, what they're doing, right? Whether it's their books or their subject matter, right? To have a specific targeted area. Are there any other things that you've seen that have worked really well in, being able to get that time?
I think if they show that they've invested time and they've actually done some homework, it makes a difference. So if I get a message that says, hey, I read your book, I found this part in chapter 7 really interesting, and I had a question I wanted to ask you. Here's my question. That is a lot different than, I love all the content you're sharing. Can we do a Zoom call sometime? It's like, I have no idea what they're asking about. I don't know how long the time commitment is. I'm not sure if they've done their homework, if they're trying to get what they're trying to sell me on. I don't know. And so I think it comes down to you showing a little bit of effort on your end before you make that ask, because people get bombarded with those types of messages every single day. So you've got to stand out.
You talked about a little bit of give and take. Is there ever an example of someone who's been able to give you value as part of that initial kind of outreach that was like, hey, they've done their homework, right? They know what they're asking for, and B, I think I would get value out of, engaging here, right? Is there any element of that you've seen that's been done well in terms of having a give and take?
I've had people reach out and say they wanted to introduce me to a potential client, and here are the things that they thought would make it a good connection. I've had others try to get me on. They say, hey, I have a connection to a journalist at a big company that could feature you in an article. But first I need a little bit of information and I want to get your advice. It's like, at least they have something that they're bringing to the table, or even get me on a podcast. It's like, if they're going to make an effort to at least give a little bit back, then I have much more willingness to carve out time, versus the person who just feels entitled to an hour of your time for free advice.
Very millennial thinking.
Yes. Yeah. I can afford the cup of coffee, and I don't even drink coffee anyways. But so if you do your homework on me, realize don't offer me a cup of coffee, because I don't drink coffee anyways. But
there you go. That makes two of us. My coffee meetings are always me grabbing a juice and usually sitting outside, but fascinating. Can you talk a little bit about the evolution of your portfolio and kind of what you did? And then kind of looking back, is there anything you would have changed in terms of kind of how you went about your investing? So it sounds like you had this weekly investment that you had, and kind of where did you start allocating and placing it? And, looking back, would you have changed anything in those earlier years?
Looking back, I would have bought Tesla stock instead of my Tesla in I was one of the first Tesla buyers. In 2012, I got a Tesla Model S. It was so brand new that people were like, what is that car? How can that be electric? And people would stop and take pictures, and it was crazy and it was fun. And it was based on the recommendation of a friend who was a car guy, because I don't know anything about cars. I just said, I want something fast and really, really simple and high tech. And he's like, well, there's this new company called Tesla. And honestly, back then, no one had heard of it. And had I bought the Tesla stock instead of my Tesla car, it would be worth like 19 million right now. And I sold the used car for like 30,000. So
You're saying the cash outlay for the car would be worth 19 million.
yep, I spent 120,000 on the car in 2012, and it would be $19 million worth. Instead, it was 30,000. So I definitely failed on that one. I haven't always invested weekly. I invest in stock market based investments. I will continue to do that every week. The journey for me was, once I build up a substantial kind of liquid base, and when the markets crashed in 2008, I got more aggressive. And in 2009, I started buying rental properties. And so my wife and I bought some single family homes and duplexes and fourplexes. And, those have done great. They're probably 2 times to 2.5 times the value of what we paid, and they're all rented out. In the last few years, I've also started investing in some, we bought some medical complexes, so some commercial real estate, and then some apartment buildings in Georgia and Arizona and Tennessee, places where I feel like all my neighbors are moving to from California. So just looking at where, like Wayne Gretzky said, where the puck's going instead of where the puck's already been. But as far as investing, I don't think I would change much, other than I would have invested more when I was younger. I wish I would have invested a lot more when I was younger, because the time value of money and the time of compounding is the most valuable asset we have as investors. So it's something I'm teaching my kids. My kids have Roth IRAs, they have college investment accounts, and I'm getting them to invest at a very, very young age, because that time will make so much difference in the long run with the compounding. So
You talked about your new book that's coming out next week that is targeted, if I remember correctly, around kids and establishing those habits. What's the one nugget you would give to people with kids that are, trying to instill some financial literacy, that you would say, just start here?
the book is Smart Not Spoiled, and 70% of parents in America believe their children are spoiled or entitled. So the challenge I see with that is twofold. Number one, it's a comparison generation where people have social media and they compare to everyone else, and they're comparing to the best wins and highlights of everyone else online. That's a challenge. But the second challenge is they haven't been properly taught about money. The schools don't teach about personal finance, and most parents don't either, because we don't know where to start. And so my whole reason for writing this book was I want to get something in the hands of all parents, grandparents, guardians, mentors, coaches, whatever, who can help pass some wisdom on to the next generation and actually empower them to be thoughtfully prepared, financially thoughtful, just like successful, financially savvy young adults. So we don't throw them out into the world at age 18 when they can dissect a frog and they can tell us what the memories of a cell are, and they have no idea what investing or taxes or anything else is. So I think there's a lot of useless information, in the public school system. And yet here we are, just like throwing them into the world, and they're getting credit card solicitations and student loan solicitations. And so I really believe that it's on us to teach the next generation about money. And so that's the purpose of that book.
It's so our business is in the mortgage space, right? We do all financing on real estate, and it's amazing to me, some of the clients that we talk to that don't know how to impact the credit score, right? Don't know why it goes up and down, right? Don't know, credit cards and implications, and it's just fascinating. And to your point, it's never taught. It's expected that you experience it and learn from it, which is sad,
Yep,
given what an important role it plays in our society, quite frankly, right? In our financial institutions and
absolutely.
uh, fiat money. Yeah. So anyway, I go back to my econ days, but I appreciate all the insights as we're wrapping up here. Any kind of additional words of advice or wisdom that you want to leave with the audience?
Yeah, I would just say one thing I'd like to share with people is that financial freedom is attainable to anybody. And regardless of income level, I believe you can achieve financial freedom with some strategic planning, with some forethought. Financial freedom to me really means the absence of worry or stress about your money. It doesn't necessarily mean you have $25 million. That's not necessarily financial freedom. It depends on your cash flow and your spending, but I really believe that we can empower people to have less stress and anxiety around their financial life, around the markets, around their business. And that's my mission. It's really to help people enjoy life by removing their stress about money. So that's why I do what I do.
How can our audience connect back with you? What's the best way for them to get in touch with you?
Two ways would be LinkedIn. Follow me there, and I'm active there and I respond there. Actually, I'll respond there more than I will on my emails. So LinkedIn and pacificcapital.com. So if you want to schedule a quick free goals conversation, you can go to pacificcapital.com there. You can also subscribe to my free newsletter there. So
Awesome. Appreciate the time today, Chad, and look forward to staying connected.
thank you. Appreciate it.